Good afternoon and welcome to the Future of Finance Trade Finance webinar. I shall now hand you over to Dominic Hobson, who will introduce the panelists. Thank you.
Our watchers and listeners in the Americas, good afternoon to our peers in Europe, and good evening to our friends in Asia. I'm Dominic Hobson, co-founder of Future of Finance, and it's my privilege to moderate this panel discussion on the digitization of trade finance. Now, trade finance is a small world in some ways, but it's also a very big business, a global business and a crucial one. Somewhere between half and three-quarters of the world's trade needs finance. Every bank that matters and every corporation that matters is involved in some way in the industry. And that fact alone poses massive problems of coordination. And then there are all the other intermediaries involved, from logistic firms, shipping agents, storehouses, storemen, warehouses, to say nothing of lawyers and regulators. And 195 separate jurisdictions around the world. Yet at heart, trade finance is a relatively simple business. Banks have to decide whether to pay to support a shipment, buyers need to know whether to pay for it, and sellers need to know whether and when to release the goods. Despite that simplicity, creating smooth digital processes that span the financial, the commercial, and the physical world across so many different jurisdictions and so many different market participants at such different stages of commercial, technological, and economic development is far from straightforward. Now, to help us work out where the trade finance industry has got to and how its progress towards full digitization can be speeded up, I'm joined by 5 experts in the field. Daniel Cotti is a trade finance, fintech, and blockchain expert and managing director at the Center of Excellence in Banking and Trade at the Marco Polo Network in London. Gabriel Buck is the founder and managing director of GKB Ventures, a specialist consultancy he set up after 27 years in structured trade and export finance at Barclays Capital. Jackie de Jong is a global head of sales at Bolero International. It's a 22-year-old tech firm dedicated to the digitization of global trade. Philip Burat is a director at JCB, which is probably the best known engineering and manufacturing company in the United Kingdom, specializing in construction equipment. Simon Ring is Global Head of Regulatory Technologies in the Financial Markets and Compliance Division at Polestar, where he works with trade finance banks, trading companies, issuers, shippers, and governments. Now, we've got a lot to get through and not much time, so let's get going. Philip, could I come to you first? You're a manufacturer and an exporter. In other words, you're a consumer of trade finance products. And we read about an industry which you use that manufactures a lot of documents. It exchanges them by email and PDF attachments, and it's now just discovering the joys of the OCR reader. Is it fair, in your opinion, to describe trade finance as a digital laggard?
Well, thank you for the introductions, Dominic, and I'm delighted to see we've got so many people listening to us today. I think laggard's probably a good expression. I've been hearing about optical character recognition for as long as I can remember. I'm showing my age slightly, but I remember the days when we had first and second sight draft exchange documents and couriers running to the Chamber of Commerce and then back to the bank, and then the bank saying, you know, we can indemnify this because there's no decimal point after C and before T in the description of the product. So yeah, I'm almost a dinosaur in this. And I remember spending literally weeks with documents and having to go and present the documents myself to all sorts of weird and wonderful banks all over London. So if I wind forward, we still today have a blend of hard paper, photocopied paper, faxed paper, you name it, with certain countries around the world. And I think coming back to the word laggard, there are some countries which are still, as I originally described. If you do business in Iraq today, you're dealing with site drafts and you're dealing with everything else that you used to deal with almost 40, 50 years ago. And with India, we're still not weaning India from the sort of raft of clerks who are there to put a signature or a rubber stamp on that next piece of paper before it can move through the chain to eventually pay you. So obviously business in most European countries and the United States moves very quickly, and there's a very high degree of digitization, and we're all very, very used to that. But the rest of the world hasn't yet caught up. I mean, according to WTO, world merchandise fell 14% in volume and 21% in value in Q2, amid the global lockdown. I also find that talking to people at Export Credit just this morning, that they are having to reassess their lines of credit literally globally by almost, pulling countries off the map and saying, right, how do we feel about this country at the moment and what's the situation? So as a company, we at JCB have about 150 active countries run by our dealer network. We have 23 factories, and we have something like 96,000 just spare parts available at 12 hours notice for dispatch anywhere in the world within 24 hours. So that operation needs a massive amount of paperwork behind it. Is it getting better? Yes. Is it actually getting easier? Yes. But there is still a blend. It isn't just this is the system. I know primarily the more up and running systems are Swift based, but do they actually talk to the other systems? And I don't know who did this, but I'm looking at a sort of Catherine wheel chart of various companies and various interactions with various sub companies, and I'm looking at that thinking that is the most complicated I've ever seen, with freight and shipping on the right still needing lists of credit and bills of lading effectively, and commodities moving much faster on the left, because we know what the commodity is. You don't have a great description of the product and have to wrestle for the harmonization number. Wheat is wheat, and fuel is fuel. But when it comes to a manufactured product or a component, it gets a lot more difficult. So I'll stop there, Dominic, if that's okay.
Thank you, Philip. That's a very full background from a consumer of the product, as it were. Daniel, perhaps you could give us a view. You've heard what Philip said. Why has it been so difficult to digitize trade finance? After all, Jacko's on the panel. Valera's been around since the late 1990s. We've had SDocs and ELCY since the early noughties. Why is it so resistant to change?
Well, if I knew, I would tell you.
That's why you're on the panel. You've got to tell us.
No, look, the various business models that are in place are not scalable. And there is not enough incentives for the parties to really use the fully digitized version of trade finance, if you so want. And all efforts that have been done over the past 20 years are vertical efforts. Everybody has fixed a certain path of trade. And we all know that trade is very fragmented. It's very complex. You have up to 20 parties, 30 parties involved in a single trade transaction from different industries, from different areas. And a horizontal, lateral connectivity has not happened. So everybody is recording information on a system and then produces a paper or produces an email with a PDF. So that's the way the evolution has taken place over the last 20 years. And only with the combination of new technologies coming at light, like DLT technology, like the cloud technology, like APIs. These are the drivers and enablers that allow integration on a horizontal level. So, and I think that's what you see happening now in the industry at large. Obviously, there is external pressures, like we heard before. COVID-19 is one that is really driving digitalization, because the inefficiencies of semi-automated or totally manual processes have become very visible to many parts in the world, and therefore are suboptimal, right? But the complexity to digitize trade end to end, so you have machine to machine trade finance, is enormous. And because there are so many parties involved, and I think we are at a huge revolution of the industry, and it will take time. But I think we now have the technologies that enable full digitalization. Versus 20 years ago, 10 years ago, we did not have the technologies.
Thank you, Daniel. I'd like Simon's comment, in fact, on that question of interoperability, which you've raised. We'll put COVID to one side for them. But first, perhaps I could come to you, Jacko. You've been at this more than 20 years. What are the obstacles you've encountered in the digitization of trade finance?
Yes, so allow me to combine a bit what Philip has said and what Danny has said. So Philip, I was at the bank handling those documents, those paper documents way back, even before the computers were there in the bank. So I've seen everything under the sun there. On e-presentations and the use of electronic documents, and indeed we've been active there for over 20 years, next to our efforts, in the multi-bank connectivity, allowing our corporate clients to connect with multiple banks on these transactions. But to get going with electronic documents and electronic bills of lading, it is a long process. And yes, you need a legal infrastructure, but you also need key players to be involved. Now, why did we start in these verticals? Is because, if you want countries, if you want ports, if you want customs, if you want banks to accept the use of electronic documents, you need big corporate players behind you. If I would go to a bank or a carrier or even a customs organization and say, this is a small exporter on the corner who wants to do a trade electronically, they will say, go away. If I come with a big international commodity player, then it's a different story. So that's why we had to start with the big commodity players out there in the energy, in the agri and all these other areas to basically pave the way for electronic bills of lading and electronic documents to be used. Now, fast forwarded to today, also to Danny's point, right now, I know you're going to park COVID a bit, but one of the impacts we have seen and why we have seen a spike since March, April of this year in, the issuance of electronic bills of lading and the use initially of those documents under open account transaction, clearly is because the paper documents got stuck around the globe. Right now, we also see that the banks that we have been talking to in the past, who we're a bit reluctant to do e-presentations and the use of electronic documents, have now said, our BCP processes, business continuity process, has fallen over because we had all these scenarios that, a city would go out of power or, there would be some disaster locally and you would just pick it up at a different location of the bank. And now suddenly, because of the pandemic, people had to work from home. How do they access these documents that they need to check? So I think having done the groundwork in the past on legal infrastructure, on, enabling a lot of ports globally, enabling a lot of banks already globally to handle these electronic documents. Now we can sort of capitalize on that. And yeah, the unfortunate crisis will be an accelerator there, definitely.
Thanks, Jack. Now, Simon, I'd like to pick up something which Daniel, Philip, and Jack have all mentioned in their different ways. You've got a lot of people involved in your average trade finance transaction, not just banks, but insurers, export credit agencies, shippers, corporates, and so on. How good are they at actually exchanging information in digital form at the moment?
Yeah, I mean, as Jacko referenced, I mean, obviously there is a growing trend in these areas. I think remote working's driven that COVID-19, but it's been growing for a number of years. And I think the reality of when you talk about interoperability and sharing of data and information, that's been talked about for a long time now. And there are lots of sensitivities around that kind of information. But for me, the important thing is, I mean, I know Jacko and Danny very well. We've been in alliance and working with other technology companies for a long time. And solving big industry issues is not something that any one singular company can do on its own. So I think the FinTechs, the RegTechs, the technology companies that can synergize and have the same goals and aspirations need to work together much more closely, and we're starting to see that happen. My own world is really about what has become part of trade flows. The regulations around 90% of world goods being moved by maritime sectors. So the automation, digitization of compliance and sanctions screening and processes have become key, whether it's business as usual or it's trade platform related businesses. The automation and execution of these things is critical. We've seen an escalation of that, just this year with, you know, advisories coming from the US and OFSI and others around the world in terms of the risks. So for all of the collaboration and synergies that we have as companies and certain companies that we work with, the reality for me is you've got to have the same aspirations and goals, and they are about automation, the streamlining processes, making things commercially more viable for corporate users. And if you share those aspirations, you can work with other technology companies in building and synergizing process that's all geared to the same thing. So that's one of the reasons we work very closely with many, you know, the other tech companies out there.
Thanks, Simon. Gabriel, something which Danny said, I think, is that the major commodities house gets treated differently from the small exporter in an emerging markets economy. It sounds to me, listening to some of this, that the industry is always going to have to proceed at the pace of the slowest ship in the flotilla. Is trade finance condemned to do that, or are we able to make better progress in some sectors, some groups of clients, and some types of industry, like commodities, as opposed to the type of manufactured goods which Philip exports and manufactures? Are we always going to be proceeding at the pace of the slowest boat?
In a nutshell, yes. I think, but I think in many ways, Danny and Jacko hit it on the nail. It's about size. You need to be hitting, you know, the major corporates, and I think part of the problem is there's such a large, and I'm looking from a bank perspective, there's such a large concentration risk of the number of banks that do trade finance. The recent ICC, International Chamber of Commerce survey showed that 90% of all trade finance is done by 13 banks. And then within that, there's a big concentration to between 3 and 5 banks. So, and as an ex-banker myself, as a bank, if you're one of those top 5, then clearly there's a benefit for you to go down a digitalization route, because it gives you that economies of scale, and it gives you that reduction in costs, much more greater efficiency. But herein lies the problem. You know, trade and global trade is by definition, you're having to go through all of the parties that we were talking about, and with counterparties all around the world. And I think that's the problem, where we don't have a standard tech platform, where we don't have consistency in terminology. This whole digitalization is vulnerable to, let's say, a small bank in Zambia having the funds and the expertise to be right at the end of the chain and being digitalized. Because if they are working, and there's no incentive, as Danny was saying, there's no incentive for them to be digitalized, and they are working on a paper system, then I'm afraid the whole system starts to grind to a halt. There isn't an incentive for that small little bank in wherever to go through the cost of doing that. So yes, unfortunately, we are at the start of the beginning on this platform, and it will just take quite a long period of time until everybody's incentivized to go digital.
And there's no incentive for those 3 to 5 banks which dominate trade finance on a global scale to help that bank in Zambia, give them a quick little SWIFT terminal or something. No,
in a nutshell, because if you do that, then everybody benefits, and you know, we're already seeing a stress and a strain in the banking industry when it comes to trade finance. So there's a incentive to reduce cost. There isn't an incentive to make this, you know, much more efficient on a global basis. You know, we've already got some big international banks questioning their ongoing presence in trade finance.
Especially commodity finance, eh?
Yeah, but actually commodity finance is often used as the headline, but actually if you go to the detail, they'll say, we're out of commodity finance and trade. So there's, you know, there's pressure on income, there's benefit for some cost saving at a top level, but it's not beneficial for the market as a whole.
No, Dominic, I'm not allowed. Can I just make a quick comment here?
Absolutely, yeah.
So, and another risk I see, Gabriel, is also that some of the banks who are exiting the commodity finance business, it will have an impact on the regular trade business as well. I know it's not a good example to use now in the COVID times, but if an airline gives up their business class, that also has an impact on economy class and the normal things you do. And I think the same will go for the banks. Commodity finance usually funds part of the business, drives the business, and enables the normal trade departments to work as well. So there could definitely be a spin-off effect there.
Now, is this problem of banks being reluctant to get involved in financing commodities and beyond that and other types of trade? Is this a function of KYC, AML, sanction screening, CFT, the pressure regulators are putting on people to understand, or is it something else? Gabriel?
Well, I think it's a combination of things. I think that banks, the cost for banks to go through a KYC, AML, DD is anything between 30 and 60,000 US dollars per account. So that drives banks, if they're in this business, to go for the larger corporates. It's very difficult to justify all of that cost to take on and onboard an SME. I'm not a firm believer that digitalization will reduce the cost of banks to onboard new clients, because you still have to go proper due diligence. And I think some of the problems that we have seen recently is that there's been, I've got to be careful about words here, because some of these cases are quite prolific, but there hasn't been a proper due diligence been undertaken. The banks involved have been getting involved in bigger and bigger transactions. Those that have been fraudulent, and we're talking about fraud here, are just as easily motivated to undertake a fraud from paper to digital. And the banks have lost huge amounts of money on single transactions. We're talking hundreds of millions of dollars losses on one transaction. So when you've got that systemic risk inside a trade finance or a structured trade and export finance or commodity finance business, other people in the bank are saying, what the hell's going on? It's safer for us to be out of this business. So, I think there's some more greater problems associated with trade, which I don't see digitalization really assisting, unfortunately.
May I have a good answer to this question, which is called digital identity. But yes, Danny, do go ahead, make a point. I'd like Philip.
Yeah, I don't quite agree with Gabriel, because I believe digitalization can help to minimize fraud. And just take the example of the commodities industry. I cannot help myself but be very appalled by reading that banks finance hundreds of millions based on a paper and a paper bill of lading that can be easily copied and presented at multiple bank counters. If they had used an electronic bill of lading where a title registry confirms who the owner is in either S-Docs or in Bolero, that would not have happened.
Okay, good point. And you should all watch our digital ID webinar in a few weeks' time, which I think is...
I think the real issue is, if I may, Danny, I agree with you. I think it's, but to say that digitalization is in itself a panacea for stopping fraud, I think it's a dangerous statement.
No, it's not.
To make.
I didn't want to say that. I agree.
No. But I think the problem is that digitalization or reducing costs has been the driver for a weakening of old school due diligence, KYC. We've had, from what I've read on these cases, this is an example of banks not really understanding what's going on, not really having a deep understanding of who their client is. All I'm saying is that due diligence, if it's not properly undertaken, causes a problem, which causes a problem for the industry. And digitalization is not that solution. I think it's just greater due diligence.
If I may spend 1 second on this, I think you're both right. I think one thing is that the banks have sort of starting to cut costs on what we call the mid-office in commodity finance. Those are the people with the expert knowledge. They monitor the collateral, the facility usage, the lots in the warehouse. They physically go there from time to time to check if they're there. That's been cut at most banks. And the other thing is indeed, if you go digital, you will drastically reduce the risk of fraud. Indeed, if you have with us, if you're the pledgee of a bill of lading, you're the single pledge holder. So definitely, it's a handshake between the two. I think better due diligence and the use of digitization.
Yeah, I just wanted to add something to that as well. I think we all recognise that financial crime risk comes in a multitude of different formats to financing institutions, and you have to have. This is where I think collaboration and collectively synergising certain technologies works, because to really get a clear picture of some of the instances, Gabriel, you're talking about, a digital bill of lading will have helped. Maybe more enhanced due diligence on the actual corporates themselves can help. Monitoring transactions can help. And there should be no doubt. I mean, working in that regulatory space, it's been the commodity sector the regulators have been focused on for quite some time, and that's for a specific reason. It's things that are transferable at seas, that find their way into comprehensively sanctioned countries, that has been at the top of the agenda for certainly the US and other regulators for quite some time. But a combination of those solutions working together is definitively far better than what we currently have. There should be no doubt in anyone's mind that this is progress.
We've had
go back to the beginning.
Philip, could I direct you? I'm sure you want to make a comment, but one of the things I'd like you to answer in what you say next is, you heard Gabriel say that banks are now much more focused on the large corporations than they are on the SMEs. I assume most of your dealers and your customers are SMEs, and so I'd like you to just give us a comment on how problematic that is for you, that banks are withdrawing support from the type of people you're presumably having to work with on a day-to-day basis.
Thank you, Dominic. And I'd like to come straight back to something that Jaco said, and that is the demise of the experienced middle office. And I think the demise of the experienced middle office is causing this horrible phrase, the computer says no, which came up as a comedy sketch originally, but it's absolutely true, because people are now trained to look at the output from the computer rather than look further behind or look further under the hood. Basically, I'll answer the bit about the SMEs, but governments do business with governments they trust. Companies do business with companies they trust. People do business with people they trust. And this is the beginning of the relationship, the product or the commodity moves. And what we're discussing today is, once that deal has been set up and they want the product and they trust each other, it's how smooth can really the financing operation of that become. So coming back to the question, are the SMEs having more of a problem? Yes, they are, because of the demise of the middle experience. It isn't just about electronic documents, I'm afraid. There is a human interaction part to do with all of this. And you still, in our business, we still strive to pick up a telephone occasionally and have a chat with somebody we know. I did it this morning with the chief executive of our own export credit agency over a line of credit to a Middle East country that we weren't sure was where it was 3 months ago. So I pick up the phone and say, hi, where are we on this? There is no computer anywhere that's going to tell me that, but he'll give me a very good steer. Yes, we proceed, or we don't. And he'll say, as long as it's underwritten by the Ministry of Finance, that's not a problem. So then I just want to pick up a thread that somebody mentioned Zambia. It could be any country, but countries like Zambia, who are not as developed in their banking systems, we still use that very old expression, and Jacob will remember this from his document days. We would like the letter of credit confirmed and irrevocable on a large and reputable UK bank. End of story. And I'm afraid we still live in that world. And I dealt with something literally last week on that basis. We said, no, we want it confirmed. And they said, well, your cost? No, your cost. This is, if you want to use this bank we've never heard of, I want somebody like HSBC or Barclays to say, yes, we will confirm that letter of credit.
Right. Isn't Gabriel saying that's exactly the type of business the big banks don't want to write now?
Well, put it this way, they don't want every bank in the world clamoring for them to confirm it because it gets too complicated. So what Gabriel said is absolutely right. It does get complicated, and we wind up then having a bit of an argument with the buyer, who then does eventually find someone to get it open confirmed by a major bank.
I'd like to move on a bit to talk about how we can digitize trade finance. But before we do, we've had a comment here which I'd like to see if anyone's got something to add to it, which is from Mike Ronda. I hope, Mike, I pronounced your name correctly. Digitization enables banks to control fraud much more. Paper bills of lading can be checked by a simple storage and check on the BL number once digitized. For example, Trade AI software offers this functionality. It can also help to avoid duplicate documents and presentations, etc. It can also do automatic sanctions checks against all OCR, raw text data, and so on. So this is the point you were making, Daniel, that digitization of documentation can actually help. It's not a complete solution, but it can help. Is there anything to add to that? No?
I can quickly add to that. So, Mike, thanks for the question. Nice to hear a question from the Netherlands. So yes, of course, data, if you have electronic data, which is like a bill of lading, an electronic data bill of lading, which is native electronic document from the start, yes, definitely that data can be used to perform checks, for instance, against, from Simon's angle, against, where is the vessel and those type of things. And from Danny's angle, it can be used as data to trigger a smart contract. So definitely, and that's why electronic bills of lading are much more easy and reliable than paper bills of lading. And also, let's not forget, the moment that a vessel or a carrier issues a paper bill of lading, thereafter, it's out there, and it can be endorsed, it can be, anything can happen to it. With an electronic bill of lading, you always know, where it is, and you have the data. So I think it's a good point.
And also, just coming back to Philip, your point about human beings. I mean, I've always believed in what we do in terms of the interaction between technology and experienced people in risk and operations centers, is that technology will find the needles in the haystack. Rather than looking through thousands of transactions on an intraday basis, what we try to do is focus those experts in their field on the issues that need their attention. Technology does that really well. Yeah. And if you can cut through the vast transaction flows, as Gabriel mentioned about the top 13 banks doing 90% of world trade, the reality is that the amount of paperwork and documentation that's coming through that institution on an intraday basis is so enormous, and technology can filter that down. Normally, for me, risk and operations, compliance are the busiest people in the banks these days. So if you can filter and point those people in the right directions with technology, that's how they work together, I think.
I totally agree with you on that one.
Okay, I've been asked to get closer to my microphone, so I hope I'm being heard loud and clear now. Could we just spend a few minutes talking about which aspects of the trade finance industry are actually making progress? And I sat down and I tried to work out all the things which go on in this industry. It's not where I come from. I'm a securities market person, but there's so many different processes: documentation, physical shipment, financing, payments, working capital, communications, transaction management, underwriting, credit risk, sensors. It goes on and on. Is it possible, Simon, to say, well, here are some quick wins we can get in this industry. Here are clear areas where the industry is actually making progress towards digitization. And if so, what are those areas?
I mean, from my perspective, the work we're doing with Danny and the guys at Trade AX and Marco Polo is a perfect example of that, where data matching engines can match information in trade flows. The banks and the financing institutions want the risk mitigation, but they'd like it to be automated. And if you can do that through nodes in one of the blockchain communities, much the better, much the more automated and smooth that process is. So I think there is definitely progress. Some of these programs we're looking at will go live soon. They're real, they work, and they have a lot of big institutions behind them. But I think that's just the start. But the reality is the risk mitigation and the trade process almost go hand in hand now. You can't do one without the other. So the corporate KYC, the due diligence on the customer may be done externally, but the reality of the actual automation of the trade transaction needs a multitude of pieces for it to be automated. And without it, it won't work. So that's exactly why I've been working. Danny, over to you, but you're the expert in those areas. But
Yeah, I think that's what we are seeing happening, and that's what we're trying to do with the Marco Polo network, is that we digitize these processes of risk mitigation and financing. We deal with data sets. We handle documents as attachments in PDF if they're still required. So it's really a path from the old world into the new world. And we team up with a third-party service provider like Polestar, who is a leader in the e-bill of lading scenario, compliance scenario, etc. And we are also working with the emerging ESG provider, so Carbon Chain or Rainforest Company, that are providing certificates that can be used in a matching exercise. Today, all these processes are super manual and cumbersome, and various banks have stopped using them or have difficulties using them because it's all manual, more documents added on to already a manual process. And we can digitize this with the Marco Polo network. We have already use cases. We partner with these banks, and we will have this up and running in the first half of next year in a way that will allow and will drive benefits to both corporates as well as banks, as well as the third-party service providers.
Gabriel, as you view what's going on with the various digitization initiatives, do you feel the scene is too chaotic? Are there too many initiatives going on? Does it need somebody to bring all these threads together and provide an overview of some kind? Because as we've heard repeatedly, this is a very complex, very fragmented industry. Is there a body which could do some consolidation work on digitization initiatives, or must we just make progress where we can?
Good question. I don't have an answer to that. I think there is a need to have consolidation when it comes to the tech, when it comes to the terminology. We need greater consistency so that everybody's working off the single platform. And I think that the challenge is that you have a number of different platforms and different terminologies, which is causing a bit of confusion. I cannot think of an overriding. I can't see it, the OECD or ICC, but I'm not close enough. I think that's to take that ownership, and maybe Danny or Jacko could have a viewpoint on that. Yeah,
there are some initiatives there, like the DSI, the Digital Standards Initiatives, and I'm part of the steering group for digital trade for ICC as well. And there, for instance, I'm co-chairing the FinTech adoption stream, for instance, also to make it easier for FinTechs to work with banks. If you're a FinTech, you have a product, how do you go about, introducing that to a bank, and what do you need to think of? So I think there are many things happening in that area that we're trying to see. Can we find common denominators? How can we work together? From our perspective, we have now introduced like your EBL as a service, basically, that we are enabling it to be plugged in, for instance, to Marco Polo or other initiatives like Contour, what have you. I think before you have a global standard, it will take a long time. Until then, you have to focus on interoperability. How can you connect? How can you work together? And how can you make sure that it doesn't really matter, who is actually, is an EBL used under a traditional LC, or is it used under a Marco Polo smart contract? It's still a transport document with transport data, and it has a certain function, for instance, as a title document. I think that's for now key, and over time, hopefully, there will be some global standards, but it is a long way, especially when it is around government to government topics on, certificate of origins or phytosanitary certificates or those type of things. It will be a challenge.
Yeah, but I would like to add a point here, because the industry has made good progress over the last 3 years to debate standardization, to understand the importance of it. And now with the DSI, the Digital Standards Initiative of the ICC, we have now a vehicle that can tackle this. I agree fully with Jacko. This will be a decade long of work to have standards similar to the telecoms industry, for instance, right? We can send each other emails no matter who the provider is. We we can use our mobile phones all around the world. That wasn't the case 20 years ago. But standards in that industry helped that happening. And the same will be on the trade side. And with Oswald Kuiper, the DSI has a leader that comes from BHP Billiton. So it's a practitioner that understands the day-to-day requirements and the suboptimal scenarios of today's systems. And he is going to drive these various standardizations that Jaco has mentioned. E-bill of lading is just one of it, right? There are like 20, 30 others that need to be tackled that are even more complicated than the e-bill of lading. And so I'm cautiously optimistic that the industry now understands the importance of standardization, and I sense a willingness for them to work together.
Yeah, and I see also a big role there for the development banks. Like behind the DSI, all the 4 major development banks has teamed up to also support that initiative, also to try and, to close the trade finance gap out there. And also to Philippe's point earlier on the call, the development banks also help out with, enabling confirmation on certain transactions by just, issuing standbys to cover the risk. So I think the development banks also play a big role here as well.
We have a very important question, which I'm going to ask. But before I ask it, I'd just like to say, we talked a lot about standardization. 20 or 30 processes need to be standardized. Where is Swift in all this? What proportion of the chain do they cover? Is it 20%, 30%, 10%, or 90%? Jaco, I'm hoping.
Yeah. Oh, yeah. I just don't want to take over. I just don't want to take over.
Just a very quick answer on that. What proportion of the chain are they covering?
From a trade perspective, right now their main focus has always been on the transactions, so enabling the MT7 messages between the parties. Next to that, of course, they have the File Act to transfer files, which they're now also opening up to exchange documents as well. So I would say there's a renewed focus and interest in trade from a Swift perspective. I think
it's mainly still in payments, right?
Definitely. If you look at Cybos this week, it's if you look at the trade session compared to the cash topics.
Oh. Okay, now here's our question. It's from Merlin Dowse. What are the panelists' views on the role of the regulators or governments in driving the digitization of trade finance? Gabriel, that's a natural for you because we talked a little bit a few minutes ago about how difficult it is to consolidate what's going on in this area. Is there a scope for governments to step in and say, well, look, just get this done?
Yes, but the reality is, and I go back to this, this whole cost for the banks in terms of onboarding. I see when I look at the volumes of business that's being done, I look at how it's being dispersed amongst the banks, there's an ever greater concentration risk of more and more trade done with fewer and fewer banks and with less clients. And I think the regulators have caused an industry within the banking market that has made it very difficult for new players to come in, and digitalization, I think, will assist in this. But at the same time, it's very difficult for the points that were made earlier about new clients being onboarded. Mm-hmm. So I think you have to be careful to look to the regulators or governments to come up with a solution. I think it needs, as someone said right at the very beginning, greater incentives right across the whole industry.
Okay. Anyone else want to comment on that need for regulators to step in before we move on to some looking at this in a bit more granular detail?
I was going to mention that I think obviously over the last, I mentioned it earlier on, but over the last 6 months, we've seen regulators focusing more and more and more on trade, and specifically, the maritime elements of that. There's a host of reasons. We all read about them regularly. To regulators, certainly from that part, there was a big program run by State and Treasury over the last 18 months, collaborating with industry, many meetings, closed meetings, but essentially that took shape in what they published in May in terms of an advisory. Now that doesn't determine what people should do, but it does tell people what they should be minded of in terms of processes. It does set a bar much higher in terms of the regulations that they apply. So it's a guide as to what good business looks like, what you shouldn't do, and so on and so forth, and the process that you need to have in place. It doesn't define a digital agenda, but it helps. I think it supports that.
Philip, Gabriel's made pretty clear to us the banks are not going to pay for the digitalization of the industry, or they have no incentive to do that. What about corporates? So does it matter enough to you to want to sort of subsidize that bank in Zambia or your dealer in Zambia having a digital experience rather than a paper-based one?
I mean, corporates are very straightforward. If there is a saving to be made by technology, and it's usually by, I'm afraid, reduction in headcount a lot of the time, because it makes you more efficient, then corporates will always look to that. But will they always drive it? Corporates tend to wait for it to be presented to them and then do the calculations. Corporates are always opening the door every week to people with the latest mousetrap. And if that latest mousetrap takes your department of 12 down to department of 8 and doubles its productivity, they'll say, yeah, talk to me about it. Let's come listen. So that's not really the answer, Dominic. And I don't wish to say that it's always the case, but we tend to have homegrown ideas which we will drive, but generally speaking, the latest mousetrap will appear to make us more efficient, and then we will pay for it if it does actually put money on our bottom line.
Now, we've only got about 10 minutes left, so I'd like to talk a little bit about ways we can accelerate the digitalization of trade finance. Now, we've talked a lot just in the last few minutes about standardization, and standardization begins by agreeing there are a set of common data elements, and presumably every trade transaction does have a set of common data elements. But as one of our listeners has just pointed out, actually, it isn't really ever as simple as that. This is from a comment by Salim Amir, who says that, and he's talking about bills of lading, digital bills of lading here. He says, while digitized bills of lading may work for direct shipment, how this works for trades where middlemen are involved and bills of lading change hands several times before reaching the end buyer. Is digitalization not actually an obstacle to that type of transaction, because you need to solve legal aspects of the negotiability and transferability of those bills of lading if you go digital? So what I was saying about standardization, where you just agree the common elements and everyone appears at the transaction at the same time, you're done, there's no need for paper, and the whole process becomes more efficient, it's not going to be as simple as that, is it? Jacko, you're looking at it, so I'll throw that.
Yeah. It's about e-bills of lading, so I have to take that one. And it's a good question. Of course, having a COA bill or a straight bill of lading it's much easier to handle than a negotiable bill of lading that can be transferred multiple times or endorsed or what have you. But that's exactly what we have been focusing on for the last 2 decades: how to enable negotiable bills, because trades are often done mid-sea, mid-ocean, and then you need to be able to hand over or transfer the documents to the next party. So from a Bolero perspective, that's our bread and butter business. That's what we do. For it to work ideally, of course, all the parties need to be on Bolero, because the person or the party who you're transferring to also needs to be on Bolero. But even sometime, even in our case, the chain breaks. Maybe the third person down the line is not on Bolero, or a certain port or customs still would like to have a paper bill of lading instead of a digital bill of lading. Then there's always the switch to paper option, where the last person in the digital chain can request the carrier to produce a paper bill of lading that will mirror and replace the electronic bill of lading, and then the process can continue in a paper-based fashion. I just want to make another comment that the whole world is not digital yet. But if you start to wait for adoption, it will never happen. The only way to get adoption is to get going. That's the only way forward.
Jacko, the whole world has a mobile phone, pretty much. More people have a mobile phone than have an electricity connection these days, we're being told. So
and it also started with a few phones, the size of a suitcase. So,
but even our Zambian banker will have a digital phone. And is it not possible, it's not beyond the wit of this industry to create an application which he could use, which doesn't cost him the same as a Swift terminal?
Definitely. So from our perspective, we have those tools, and we have web-based solutions that do not require anything to be installed locally on a computer or what have you. It's just, to be able to use electronic documents, especially electronic bills of lading, you have to agree to the legal framework, which is the rule book. So there is always an element of onboarding, because otherwise it just wouldn't work. But it's as simple as that, definitely.
Mm-hmm. Now, what do we say to one of our listeners, Henrietta Ayatwoma, who, hope I've got your name correct, Henrietta. She says, a one global digitized trade financing world can only begin to exist when there is a common plan to standardize. Now, who on the planet Earth is capable, we've discussed this already, but let's go back to it. Who is capable actually of devising that common plan? Is it the DSI initiative that you were talking about earlier, Daniel? Is that the right starting point for a common standardization plan?
I think it is. If you look at the transformation of industries over the past 20, 30 years, various industries, it's driven by technology. It's spearheaded by few players. Then is a stabilization phase. Followers enter, the solutions are proven. Then a consolidation is taking place, right? And the same path will happen with these emerging networks on the trade scenario. And I think this DSI is the closest thing to have a trade industry body. And I'm not saying a trade finance industry body, I'm saying a trade industry body, right? Which encompasses not just the banking and financing world, but the freight forwarders, the carriers, the port authorities, et cetera, et cetera. And I think that's the master plan.
Danny, can I ask you a question on that? How long do you think it would take before you get to that consolidation?
I think it probably 5 years.
As short as that?
Because 5 to 10 years. Because I think when we had the DLT hype 2 years ago or 3 years ago, we have now realized over the past 3 years that it's not so easy and it's not so quick, right? But the technology is an enabler. It makes it work. And we are all grappling with the legal consequences, the commercial consequences of this technology, how to deploy it and how to make it work. And it will take time to scale it and to make it a new market standard. But I'm sure it will happen over the next 5 years, 3 to 5 years. This will happen. Winners will emerge, and then a consolidation can then start happening. So that's my forecast.
Some of the drivers for this process don't come from always the obvious areas. So, if you take an example of the United States, 60 million containers go into the United States every year. They inspect under 1% of them. Now, if you put technology around that as a process, data matching and so on around it, it may be that's the driver, but it will still drive the digitization of the process. And the risk is different. The risk is different from that perspective. And there's lots of governments that will be looking at those kind of concepts now. So it doesn't always come in the same format. The risk can come in different ways, but it'll still drive that same agenda of recognition of digitization of transferable permission-based solutions that can share documents.
And it will increase the transparency, and it will the transparency for governments, for regulators, as well as for market participants. The transparency that is not there today.
Correct.
Well, Henrietta's been listening to what you've said, and she's made an additional comment, which is a standardized process, activities, common interpretation, paves the way for a required type of data to be collected in a data registry, which can then determine how far the proceeds of trade can be simplified and made efficient through technology. That's capturing those common data elements, I guess. She then asks, are there any plans for digitalization that drives the participation, inclusivity of more SMEs, more women, in fact, in trade transactions, given their worries around trust and customer experience. This gives me a chance to ask my favorite question, which is about digital identity. Is the trade finance industry looking at digital identity as a solution to that problem of how do you trust this individual, this company, this SME?
Most definitely. I think certainly that's what we are driving at the Marco Polo network. Every participant, whether it's an SME somewhere in Bangladesh, or whether it's Siemens, they will have a digital passport. That digital passport includes the identity, the digital identity, and allows the other members that are on the network to identify that party, to ensure they're dealing with a identified counterparty. And definitely in any digital scenario, digital identities are a key driver.
And does your digital passport conform with the Financial Action Task Force recommendations? Does it meet an international standard? So are these things portable?
Yeah, yes, they will be. And we are also embracing, and that's also what the DSI is doing, embracing existing standards. So for instance, you have the LEI, the legal entity identifier, that can be used and leveraged in these digital passports to ensure that the identities are kept current. It's not just a matter of putting them in place, right? You need to keep it current. And these scenarios digitalization will help these scenarios to really drive a level playing field.
Okay.
Small scale,
Philip, yes.
On a very small scale, as we move towards exiting the European Union, if we think of that, it all has to be digitalized, and the pre-approvement of transport traveling down the M20 or the A2 to Dover and smoothly traveling through France or any other countries will be on a pre-approved digital trusted trader basis, and your vehicle will be checked many, many, many miles away from the port, and it will be flagged to you if you are not fit to go. So we're already seeing this in movement of goods. So I would see an evolution in the same way in finance, but slowly does it.
There's an upside to Brexit as well as COVID-19. It's driving digitalization. That's good to know. We've had a question from Mark Ling. He was listening to what we were saying about how to make this happen. His question is, what's the vehicle to drive this global collaboration? Is it the ICC? Change is definitely happening, but we're still too fragmented. Now, Gabriel, I suspect, I sense you're a bit skeptical about the ability of any international body to make things happen. What would be your answer to Mark? Is the ICC the right vehicle to drive collaboration on standardization and digitalization of the industry or not? Is there somebody else who could do it better? We talked about governments as well.
I think it's two things. I think it is the ICC and the work that they're doing. I think as the Chamber of Commerce on an international basis, this would fit front and center into their objectives. But I also think it's going to be driven much more, as Danny was saying, going through the evolution, and then at the end, when you've got 2 or 3 market winners, then the consolidation. I think that economic development of an industry and the outline that Danny gave, I think will be the actual driver for this change over time.
We're out of time more or less, but there's a couple of things I'd like to ask just to leave the audience with some things to think about. One is, and perhaps Simon, you could address this, are there regulatory changes in the offing now which give us hope that digitalization will be accelerated by official action?
I think, I've mentioned a couple of times that we've seen a greater focus in all of these areas. And I think what the regulators have done more recently is recognize that 80% of world trade is financed on an open account basis. What does a bank do with a wire or a payment transfer? So widening the net to all of the component parts of supply chains. So owner operators, freight forwarders, insurers, everyone playing a part does drive an agenda. But that's happened. We've seen that start to happen and evolve now. It's been a big year for that as a process. But in terms of driving the digital agenda, I think we're already seeing that in shipping now. If you look across the big container carriers, the big shipping lines, we're seeing that already. Most of them have APIs you can interact with, they are becoming that way. And that all plays a part. As Danny mentioned, many moving parts to this that need to come together and consolidate in a format that works. But it's happening. It is happening. And remote working and COVID are all driving that agenda.
Mm-hmm. Now, just my last question, I'd like all of you to give me an opinion on this, because I'd like to end on a sort of upbeat note. Now, the trade finance industry, like most financial industries, generates a lot of data. We've talked a lot this afternoon about the difficulty of capturing that data in a digital form and structuring it and making it usable in an efficient, robotic, automated process. But is there a long-term opportunity here somewhere in all the data which this industry is creating, albeit not in the right formats for us to make much use of it now? But is the trade finance industry, any parts of it, starting to think about what new products and services it could start to develop if it was able to capture data more efficiently? Jacko, do you have a view on that?
Yeah, two angles. Basically, I would say one would be definitely fraud prevention and fraud detection. That will be one thing. And, in the areas of financing, the more access you have to data, for instance, during the voyage of a vessel with, data from IoT devices and shipping information, where is the vessel at one given time, dynamic discounting could be much more efficient, I think.
Mm-hmm.
That's one of the big drivers that we see as well. Danny mentioned it briefly earlier on, is ESG. And I think, again, technology working together for sustainability, governance in those areas with the kinds of frameworks that are building now, where banks are offering interest rate reductions for sustainable transactions. I think that will be a key driver in 2021.
Mm-hmm. Philip, is there any sources of data or information that would make your life easier, so you didn't have to ring up the export finance? I think you're on mute here. You have to ring up your friend to find out what's going on, but actually you could pick it up.
All data has a value, and the more data you have, the more you can learn. It's a bit like history. You've sort of got, it's all there. It's a question of mining it in the correct way. So all the data we have has got to be of use to us in the future in predicting how we will operate.
Daniel, any thoughts on data opportunities for the trade finance industry?
Yeah, there's a huge opportunity. There's a huge opportunity because in today's world, data gets captured multiple times in multiple systems, right? And to have data available and use AI to analyze the data and produce the right information to the right parties can bring in more efficiencies. It can bring in more efficiencies for lenders and funders. It can bring in more efficiencies for regulators to control. It can bring in more efficiencies for the port authorities to execute the transactions in a more speedy way, and you can give more efficiencies for the corporates, for the buyers and sellers, and with these efficiencies and the increased transparency, it gives everybody a chance to tackle new markets, to expand. So expansion into new geographic areas or new businesses would be much easier than it is in today's world. And data will help to do that.
Okay, thank you, Daniel. Gabriel, a very last word of the panel from you. Are you locked in deep and meaningful discussions with your clients about data opportunities in a more efficient trade finance industry of the future?
We could have an hour to answer this question. I am a firm believer that there is more money to be made in trade finance harvesting that data than there is ever in just funding the trade itself. I come from a background of working in structured trade in an investment bank. The data for us was much, 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 much more important than any of the annuity income on the trade. In reality, that was meaningless for us. And I think that's one of the disadvantages that trade finance has got in terms of industry as a whole, is that there is it's so opaque. There is no transparency in terms of the pricing on this. But once you have that and you start to harvest that, that becomes very, very beneficial. The challenge, though, is that the market's very divided. Those that do harvest that data is a very small group, but the majority of the banks who are in this business are commercial banks who are there just to book assets and provide the funding. So I don't see the commercial banking market using that data, even though they're currently sitting on it. So yes, I think digitalization will and can provide a huge opportunity to look at that data in a completely different way. And just to give you an example, it's not just about the trade. It's if you had data about the ports of South Africa and what was going in and out, you will have a finger on the pulse in terms of the GDP of that country versus Namibia versus Mozambique. That kind of macroeconomic data that can be harvested from trade, I think, is where the real value of that data lies.
Okay, well, that's a great note to end on. We'll make a promise that we'll come back to how the data opportunity in trade finance in a future webinar. But sadly, that's all we have time for now. I can see this conversation could have gone on a lot longer. I'd like to thank our 5 panelists, Daniel Cotti, Gabriel Buck, Jacco de Jong, Philip Bouvrat and Simon Ring, for all their help and insights. And I hope our audience has found it helpful and interesting. And I'd like to thank the audience as well for their questions and their comments, which have helped us find our way through what is a very complex but very interesting issue. And with that, it's goodbye from the 6 of us.
Thank you.
Bye-bye.
Thank you.
Thank you, Dominic, and thank you to our panel. If you would like to see the summary of this discussion, please visit our website on www.futureoffinance.biz. And indeed, if you would like to see the video again, that is also on our website. Many thanks.